So I purchased my first mutual fund close to 20 years ago, and you won't believe what happened within a week. The fund grew by 10,000%, and I became an overnight millionaire. And I quit my job instantly and spent the rest of my life drinking Mai Tais on a remote island. Alright, so that didn't really happen, but what did happen was as much or actually more significant than my becoming an instant millionaire. In reality, the fund really didn't do anything for several years. Actually, it lost me money for a while. But after holding the fund for many years, through many ups and downs, it taught me one of the most important skills to investing: patience. If you're new to the channel, my name is Tay from Financial Tortoise, where we learn how to build our wealth patiently and slowly. Consider subscribing if you like to build wealth together. When most people hear investing and skill in the same sentence, most people often conjure up images of complex mathematical formulas and 100-page spreadsheets. We often think of investing skills as hard skills such as company valuation, trend analysis, and financial ratios. It's not to say that these aren't important skills. I personally went to business school, and many of my classmates, myself included, have used these skills to earn our living. However, I feel like patience doesn't get its deserved attention when it comes to ranking key skills needed for a successful investor. And this isn't a surprise. It's hard to measure it, and it's hard to measure its impact. In addition, we naturally aren't very patient beings to begin with. Patience isn't a natural human virtue. For thousands of years, humans had to react to threats in order to survive. We had to be able to instinctively react to dangerous animals and quickly run from them. This is why the fight or flight response is hardwired into our DNA. It's a survival mechanism that has helped us as humans survive and thrive. Just imagine if patience was a natural human reaction to stressful situations. A lion is coming over the horizon looking for lunch. Instead of running, we patiently sit down and assess the lion: its teeth, its fur, its sharp claws. Before we know it, we become its lunch and humans would cease to exist. So our natural fight or flight instinct has played a crucial role in keeping us alive all these years. However, we're living in a different time now, and this natural human tendency unfortunately doesn't always help us, especially when it comes to investing. In fact, it often works against us. When the market is going wild and we're overwhelmed with negative financial news, our brain naturally perceives it as a threat to our investment, our livelihood, our future. Even though the market volatility isn't a physical threat, our natural fight or flight response kicks in and our brain starts telling us that we need to do something, just as if we're facing a deadly lion that is about to eat us for lunch. And when it comes to investing, action often translates to selling something because selling feels like we're protecting our money from further harm. But sadly, most often we're selling at the wrong time, like in the middle of a major dip. And we actually do more harm than good because we act it. And don't just take my word for it when it comes to the crucial skill of patience. Benjamin Graham, known as the father of value investing, preached the importance of patience in investing because to him, in the end, how your investments behave is much less important than how you behave. Think of investing and patience as natural partners. Investing is naturally a long-term endeavor. Many people call short-term making money schemes also investing, but the more appropriate label is either flipping or trading, or sometimes just gambling. The benefit of true investing typically comes after many years, not weeks or months. Therefore, patience is a crucial skill that allows investors to endure short-term hardships for a future reward. And if you just step back, life works the same way, right? Anything worth its money took years in making, not overnight. Rome wasn't built in a day. Apple struggled for decades before hitting the right strides and becoming a household name today. And you can probably identify from your own life examples where real sustainable achievement came from long-term perspective and patience. Though my wife and I have reached financial security today, it took a decade in making. We started out with $105,000 student debt 10 years ago, and only through a lot of ups and downs were we able to arrive where we are at today. So patience is not only a crucial skill to investing, but also in life as well. Warren Buffett, the Oracle of Omaha, also considers patience as a defining trait of success in investing. There are literally hundreds of books written about Warren Buffett. They all try to dissect his success. What is the secret formula to his investment strategy? What companies and industries is he investing in right now? At the time of this video, Warren Buffett is worth more than $100 billion. That is a lot of money. However, an interesting fact that a lot of people overlook is that 99% of his $100 billion was actually accumulated after his 50th birthday. Warren Buffett didn't earn his first billion until he was 56 years old. People clamor all over Buffett's investing strategy. However, what most people overlook is that his success didn't come primarily from his investment strategy alone, but the fact that he's been investing for 3/4 of a century. The curious child that he was, at 11 years old, Warren Buffett was already buying stocks. By the time he was 21 years old, he already had a net worth of $20,000. The simple fact is this: Warren Buffett's $100 billion net worth isn't due to just being a good investor, but being a good investor since he was a child. I'm not saying he doesn't have great investing skills, because I wish I had half the financial acumen that he has. However, we all miss the point when we attribute all his success to his investing skills. Warren Buffett is worth $100 billion today because he's been a great investor for 70 plus years. He is a skilled investor, but his secret sauce is time and patience. When the market is tanking, selling might feel like you're making a wise move. And when you see the market continue to fall after you've sold, you might derive a bit of pleasure from it. But what happens is that most often, the pleasure is replaced by regret and stress, because the market will almost always recover. And now you need to time exactly when to get back into the market. And because timing the market requires incredible luck, we're often buying at the high. We lost money when we sold, and we're losing money when we buy. A prime example of how this kind of behavior affects returns comes from a study conducted by a market research firm, Darbar. In their 2020 quantitative analysis of investor behavior, they compared the market returns versus the average actively managed mutual fund manager's return over a 25-year period. They found that over that 25-year period, the market had an average annualized return of approximately 10%. The actively managed funds, only 7.8%. And the key factor to this lackluster performance came from lack of patience on the part of the mutual fund managers. The average fund manager would only typically hold a mutual fund for 4.5 years before cycling in with a new fund. And all this switching in and out really hurt the fund performance, losing to the patient market by more than 2%. And in reality, the loss is more than 2% because actively managed funds charge more than standard index funds. The following chart from the street demonstrates the cost of selecting an actively managed fund. These impatient fund managers cost the investor more than $5 million in lost growth. I don't know about you, but if patience can garner me extra $5 million in earnings, I'm all for getting more of it in my life. Alright, so if patience is such an important skill, how can we actively develop it? Are some people just born with it? Or is it something I can have more of it? I surely believe that we can. It's like a muscle, like any other muscle in our body. So with the right workout, we can definitely have more patience in our life. One way to build your patience muscle is to have long-term plan. And more importantly, keep them in front of you at all times, especially during times of market downturn. Your plan was written with a lot of rationality, not emotion. It should include how much you'll invest monthly, regardless of what the market is doing. It should include what fund you're going to invest in, regardless of what your friend says is the next hot fund. And then it should include a solid asset allocation aligned to your risk tolerance, regardless of how risky you think the market is right now. Having these long-term goals and perspective will give you the psychological fortitude to stay the course. Remember, you're in for the long game, not short-term flips or trades. Second way to develop more patience is to focus on the market fundamentals. Most often, market declines are due to investor fears. It could be driven by world events, specific government fiscal policies, or just a general slowdown of the economy. Regardless, fear-based corrections often turn around. It may not happen immediately, but eventually it will correct itself. So when you can focus on the market fundamentals, you can be patient and stick to your investment strategy. You're avoiding the emotional sellout that millions of other investors are doing during a market downturn. Remember, market volatility is normal. It is the risk that we're accepting when we choose to invest in the market. So ignore the fear-mongering news and focus on the fundamentals. The third way to develop more patience is to have staying power. And what I mean by this is to never place yourself in a situation where you need to sell during a downturn in order to fund your livelihood. You want to have the staying power to ride through the ups and downs of the market. And the best weapon against that is a good liquid emergency fund. 3, 6, or even 12 months of accessible cash. This way, when the market is going up and down, you have months of runway in cash to pay the mortgage, buy food, and fund your lifestyle. Desperation often forces people to make emotional decisions because they can't think rationally. It clouds our judgment when we feel our livelihood is in jeopardy, and we make irrational decisions like selling when the market is down. Prevent this emotional decision-making by having strong staying power. At the end of the day, take comfort in the long history of the capital market. Corrections will happen, but these are temporary, and even the longest bear markets will eventually end. Have patience to continually invest during all times of the market, and have the patience to invest for the long run. This one keystone skill will literally make you a millionaire one day. If you'd like to learn more about what funds to apply your patience to, check out some of the best funds to buy here. Thank you guys for watching. Until next time, all the best.